Welcome to the weekly update, where I'll go over the action in the market for the week of April 28th through May 2nd, and we'll see how things look for the week of May 5th through the 9th. We had another solid week. Now, we'll have to see. Are we hitting overhead resistance now? Is growth finally starting to overtake value? Is the tech sector going to lead things higher? Those are the questions that we're trying to answer as we go through the different charts. Now, we are turning more positive on the daily side, but we're still looking weaker, but improving here on the weekly side. All right, so before I get into the video, I do a video every day and I provide in-depth commentary and analysis. And my videos are longer than maybe what you're used to. They're about 40 to 45 minutes typically each day, but I really drill down and look at what's actually happening. Feel free to check those out. They're freely available on YouTube right when the market closes for that particular day. For example, the Tuesday video will be available at Tuesday's close. The videos are actually designed to be viewed before the market opens, and I delay posting them publicly on YouTube and Rumble because I have a membership program where if you're a member in the program, you get access to the videos when they're immediately available. If you're interested in that, there's a link right below this video that'll take you to my website. Also, I have a daily and weekly newsletter. That's also available by going to the website and checking that out. I do make a PDF available in the description below each video so you can download the slides and look at the charts. This is the actual link to the SPX investing program, but you can actually click on the link below the video. Also, I update pivot points each day on the YouTube community tab. There are pivot points that apply to that particular day. Those can be very helpful. And there are other pivot points that last for the whole month, but I update the chart each day. I do have a private Facebook group, not really active, not a lot of people, but you can change that if you want to become a member. And I really watch YouTube and Rumble comments. You probably have noticed I don't get as many comments on the videos that I post. I go through, and if they're garbage comments, if they're spam comments, I delete them. Now, if you have an honest back and forth that you want to have, either on YouTube or Rumble, that is totally welcome. But if you're a social media expert, who knew there were like 3 million of them in the world? Or if there's a spam comment that a bot put up there, I take that stuff down. I want to guard that area so that if you want to make a comment, it's clean and you're not going to get hounded with a lot of garbage. Also, I do post on YouTube and Rumble. Okay, let's go back and talk about the week. We were up 2.92% on above average volume, which is strange because if you look at each daily chart, we're actually below average for each day. But when you look at it on a weekly basis, we're above average. And we are still mainly negative here with the technicals, but we're showing signs of improvement. Now, we've been just bouncing around really choppy. It's been really difficult. April was quite challenging. We would have an up day, then we would have a down day, then we would scream to the upside, then we would tank. Really difficult conditions. But there are things that I teach in the program to guard against that. So if you're interested, please feel free to check that out. We did get, it depends on what you look at. Inflation data came out. Now, if you look at GDP, you're kind of concerned, and that's why we tanked on Wednesday right at the open. But then the core PCE, which is what the Fed likes to look at, that came in as expected, and that's looking a lot better. We're also looking at potentially negative GDP. Now, we see that for 2 consecutive quarters, and that's probably indicating that we're in a recession at that point. Interest rates, the bond market seems to be stabilizing after really screaming to the downside and then screaming to the upside. We're going up with interest rates, but they, the action seems a little bit more normal. And then a lot of this is being caused by what's going on in Washington, D.C., with the tariffs and the trade wars and all the different things that are coming out. The news was very negative at first, and the market was not liking that. Well, now it seems to not be as bad at this point. And the market is finding a way to adapt and say, okay, we can still go up anyway. And we're right in the middle of earnings season. Over 75% of the S&P 500 companies have now reported earnings. And then there's the debate going back and forth about are we not in a recession? I update a video on the website where I go through and I look at a bunch of different charts and we try to evaluate, okay, does it look like we're going to go into a recession or does it not? We're going to get some Fed speak this week because the Fed is meeting on Tuesday and Wednesday. It's very unlikely that they're going to do anything with interest rates, but they're sure going to say a bunch. And so there'll be the initial announcement, there'll be the little report that they come out with, and there'll be the press conference with Jerome Powell. And of course, the market will be waiting to see if they get any clues from that. As far as our trend, we're still negative. Now we're turning positive on the daily side. The short term and intermediate term after Friday's session are starting to click over and look positive, but we're still looking negative here on the weekly side. Okay, just some bullet points to go through here. It was another winning week for the stock market with the S&P being up 2.9% and it had a 9-day winning streak. That's kind of a rare thing to happen. The NASDAQ was up 3.4% and the Dow was up 3%. There is optimism about the trade war situation after China came out and said, well, we might go ahead and talk to you guys in the US after all. And there are positive responses that came after Microsoft came out with their earnings. It increased 11.1% from last week. Meta had a good report. It was up 9.1% week over week. Then momentum after the S&P 500 is turning back more positive because we're back above the 50-day moving average. That's roughly at 55.82. That's what I use to gauge positive or negative, especially on the daily side. If we're above the 50-day moving average, we're positive. If we're below it, we're negative. Then there was reaction to the personal income and spending report. It showed we were up 0.7% in personal spending, and we were unchanged with the PCE and core PCE price indexes on a month-over-month basis. The market liked that. It got a double whammy on Wednesday. First, the GDP report came out. It didn't like that at all. Then a half hour later, actually an hour and a half later, then you had the core PCE come out, and that was more market friendly. So we gapped lower and then spent the day bouncing back up. And then we had the employment report on Friday, which showed 177,000 new jobs. That was a lot higher than expected. And the unemployment rate is at 4.2%. The problem with the jobs number is that they're revising down the previous number from last month, and that's causing some concern. Then Apple, it didn't do all that well. It was down 1.9% this week following its earnings report. Amazon, it was up 0.5%, didn't really jump all that much. And there's still headwinds that we have to deal with here. Economic data is weakening, keeping fear about a recession part of the narrative that people are talking about. And consumer confidence did drop to 86, where the thought was that it would come in at 88.3, and in March it was at 93.9, which is already a decline. This is being pulled down by expectations looking out into the future, coming in at 54.4, and the average 12-month inflation expectation jumped to 7%, where it had been at 6%. Then initial jobless claims came in higher than expected. More people are starting to file, along with other contradictory readings that we got from the ISM manufacturing for April. It was below 50. If we're below 50, that shows contraction. And then the first quarter GDP report, it freaked the markets out because it's causing some stagflation worries, which was a term that I first heard about in the late to 1970s or so, with real GDP being down 0.3% and the deflator, that's the inflation component, it was up 3.7%. And we're just keeping an eye on this chart. I show this every week in the weekly video because we've been coming down with inflation. And this is kind of tracking what happened from 1966 to 1982. Not that we're going to necessarily keep doing this, but this just is put here to illustrate how things can change. The way they are right now is not necessarily the way they're always going to be. We have been in a declining interest rate or inflationary environment, with interest rates also kind of going back up, though. But what we're concerned about is this dark blue line because things were looking pretty good in 1975, 1976, and then went all kablooey back in the late 70s. And that's where we got the term stagflation from, which is where you have super high inflation and virtually none of the economic growth that's supposed to go along with that. And we are above the 4.02% level with the 10-year yield. That's when it starts biting into corporate profits. Now, we're still positive. As I said earlier, earnings are coming out and they're looking pretty solid, but they're down from what we had been seeing before. And so they're just less positive. And that's what's been putting some pressure on the markets, especially the big mega cap stocks. Now, this was updated on Friday. The number of unemployed for 27 weeks or longer, that's longer than 6 months, it is ticking up a little bit. Now, if we see this really continue to go up, that's going to be a concern. Then Isabel Net, we have the rolling 8-day returns here, really looking pretty positive, with the S&P bouncing day after day for the most part. And then we also had the all employees temporary help services. The takeaway from this is when we usually go below the red line, that's when we go into a recession. That didn't happen this time, and this line's actually starting to come back up. And then the trade policy uncertainty. I don't know how in the world they measure this, but Bloomberg and Goldman Sachs has some kind of way here. And trade uncertainty really was spiking up, and now it's starting to come back down. As this was going up, the S&P was going down. As this is going down, the S&P is bouncing back up. And then I'm going to not read the last part here, but this is U.S. non-farm payroll employment annual growth. Basically, when you look at it on this chart, it's at 1.19%. And this last statement here is an opinion. I don't care about opinions. I just want data to actually tell me something here. And it's low. It's going back. We've never had an economic expansion when we're at less than 1.2%. Well, we're at 1.19% right now. So that's a concern there. Then gold, it's down as the S&P has been up. And then looking at earnings here, we have profit margins above 12% for the fourth quarter. That's why it's grayed out. It still hasn't been completed yet. Now it's down from what we were seeing previously, but still pretty strong by itself. And then doing an update here, 72%, I said 76, 72% of the companies have reported. Of those that have reported, 76% of them are coming in with earnings per share above estimates. Then looking at the intraday chart here, this is what I follow while the market's open. And we were doing okay on Monday and Tuesday, but then the first reading of the 2025 first quarter GDP came out, and that was not well received. And we really gapped down big time. But then the core PCE report came out, and we bounced back up. And then Thursday really was not all that positive. We got all the gains pretty much from the gap, but we opened here and we closed lower, and that's not a really good thing to have happen. So all the gains were just caused by the futures going up before the market even opened there. And then there was positive reaction to the employment report, and now we're hitting that 5,700 level. Now that's not a technical level, but it's a psychological level. And the more it hits here and can't get through it, the more technical it will become. Then looking at the different sectors for the 5 trading days, the indexes, all of them were positive with the NASDAQ and NASDAQ 100 being up the most. So everything was positive at the index level. But when you go back to the beginning of 2025, we only have the NYSE back in positive territory. All of the other indexes are still negative year to date, with the small caps leading things lower. The different sectors, first I sort it because we had an up week. We had industrials, that's more cyclical. That bounced up because it looks like maybe the economy is going to be okay. The tech sector, which is growth, and then we had communication, which is growth, and discretionary, which is growth. Those did okay. And that really helped the indexes to go up. And then some of the other areas like staples, healthcare, those are more defensive. And then energy, it was the only sector that ended up being down. And then looking here, we look over on the right-hand side here. This is the scooter score. It's on a scale of 0 to 100. with the financials looking good. And that's good because I went through the great financial crisis and there were some clues that things were not going all that well at that time. So the fact that this sector is looking pretty good, we like that. Communication, we like that. That's growth. And then the weaker areas are materials. They're trying to improve healthcare, which is defensive, and then energy, which is the weakest sector currently. Looking at the sectors just for the week, where we had tech, industrials, and financials positive, and then energy, healthcare, and staples. These are defensive. We want these to go down if we're more positive on the market. If these go up, then the market is becoming more defensive. Then going back to the beginning of the year, though, discretionary and tech growth areas, they got some making up to do here, where we still have the more defensive areas that are leading going back to the beginning of 2025. Looking at the relative rotation graph, where the strongest areas are up in the green area, that here we have the x-axis and the y-axis, and a lot of the more defensive areas. If you go through, and then I have the key over here on the side, you'll notice that the areas that have been coming on stronger are the more defensive areas. We're down here in the red area. These are more the growth areas. We kind of want it to be just the reverse of what we've been seeing over the last year. And looking at it more like a spreadsheet, where the areas that are actually improving, some of these are cyclical, which means they go with the economy. If the economy's doing good, they do good. If the economy's doing bad, they don't do well. And some of these are more defensive, where communication, it's more yellow right now. We want that to be green. And then tech, that's red, where we want it to be green, as well as discretionary. So these areas are underperforming right now. Now, they had a good week this past week, and they've been helping us bounce up, but we need this to be at the top of the list in green for us to be more positive on the market. And looking at the different indexes here, we have utilities, which really, it's not that they're going up, they've been going sideways, while the rest of the market's really been going down. And that's why we're seeing some strength. And then they're going up now with the rest of the market bouncing back up. We do have the S&P that's been holding up because that's a balance between growth and value, where weaker areas would be like the S&P 100, those are the biggest stocks and usually growth, the NASDAQ 100, mid caps, small caps, and then the transports. We want to see the growth areas like the NASDAQ 100, the S&P 100. We want them to be green and actually improving. And this just shows the areas that are holding up better. The S&P, the Dow Jones Composite, which is the Dow, the transports, and the utilities, and then the utilities all by themselves. Where more yellow right now would be the S&P 100, and then the more negative areas, the NASDAQ 100, which is growth, and then the mid caps and small caps, which have just really suffered in 2025, and the transports haven't been doing all that well. But all these areas are trying to bounce back up, at least in the latest week that we just finished. As far as sentiment, we finally got above 25. Now we're still negative. We're still in fear territory. We actually bumped up to neutral for one reading that I saw after Thursday. It got up to 47, but then it came back down. There might have been some imbalancing going on there. But this is actually positive because we were below 25, and the context of this is that we're going up. And we follow this while it's going up until it gets to 75 or around 75. That's when we start to think, okay, maybe we're getting a little too happy here. But right now, this is looking more positive. Name or the active asset managers, after being extreme negative, they're getting a little bit more bullish now, coming in with a reading of 59.92. And the VIX is coming down, but still above 20. So that's more negative, but the decline is very welcomed. And we're coming down here after we had been going up. When we look at cash to the tech sector, the black line going down is more positive. That means the tech sector is outperforming. Well, we were having some trouble and we were going back up here, but over the past week or so, this has been coming back down. And then these poor folks that get into the Ridex Bear or Bull mutual funds, they're getting jacked all over the place. But overall, they're more negative than positive. And for the 10th week now, individual investors have been extremely pessimistic on the market. Now, I thought a week ago when we got this report, they were still down here. I thought we were up over 4% last week, and I thought that would bounce. They're still pessimistic. So now I'm wondering what the next survey is going to show. And this also shows that sentiment is still quite bearish overall, which when it gets to be a really low reading like we're seeing now, that's when we think that maybe it's being overdone. But there's so much uncertainty right now going on with the tariffs and the trade wars that people are still concerned. The ulcer index on the daily chart is really coming down. Here on the weekly chart, it's still quite elevated. This is like the VIX or a fear gauge here. This just shows heightened fear. And we're keeping an eye on this. The spread between risky and not as risky bonds, this had been going up and that was causing some concern, but now it's been starting to come back down. And we see that here on this next chart, but this is inverted. So this going down is actually negative and going back up is more positive. Then we look at the VIX and a 3-month average of the VIX. This had been going up, but now starting to come back down as things have been improving. And we're not really seeing any change here with the very long-term moving average of the equity put call ratio. That's continuing to decline, which is still more positive than negative. Looking at the economy here, the weekly economic index, not really seeing a big change, so things are doing okay there. The Chicago National Financial Conditions Index, it is going up. It's still below the black line. We're concerned if it goes above the black line. This was the reading before GDP came out, where we were coming in negative here with the Atlanta Now estimate. Well, if you look at this, this is now what they're thinking for the first quarter of 2025. That was right after the report came out. They're looking at anywhere from 1% to about 2.5% positive, at least right now. And then we look at this where we do have 1 quarter of potential negative GDP. Now we have to have 2 quarters of negative GDP for it to be a recession, or at least there's other things that go into that, but that's kind of the real simple explanation. But for right now, GDP is coming in for the second quarter looking positive. But this is going to change many times each week. But then when you look at the New York Fed, they're still positive, and they were always positive. So what I was suggesting is the positive side from the New York Fed and the negative coming out of the Atlanta Fed. Why don't we split the difference? And that's just about where we came out with the report. Then looking at the real-time SOM rule recession indicator, this was unchanged at 27. We get concerned when we go above the red line, which we did a few months ago, but we're waiting to see if that's going to ultimately lead to a recession. There's quite a bit of lag here. But being that this is now under the red line's at 0.5, and this is coming in half at that at 0.27. So it's actually improving. And we're coming up a little bit here, but still below the black line with the smooth U.S. recession probabilities. If there was more concern, this would really be spiking up. And this hasn't been updated, though. It comes out every quarter. This is the Brave Butters Kelly Leading Index. We like it to be going down. As far as inflation, we saw some gyration going on here with some inflation reports that came out. And then CPI is going to be coming out here, not this week, but probably the week after. As far as the Fed with their meeting, there's a 97.2% chance that rates are going to be the same after Wednesday's meeting. And that's pretty much getting locked in right now. And so then we start looking out to the June 18th meeting, where there's a 65% chance that rates will be the same. And there's a 34% chance right now that they'll be 0.25% lower. But this adjusts all the time. That's why I show this next chart, because this shows right now, a day ago, a week ago, a month ago, and how this has been going down as leaving rates unchanged has been going up. Then we just want to keep an eye on the Fed balance sheet. It is declining as they said it would, as things are falling off that were purchased during the whole COVID lockdown phase. But on a year-over-year basis, the Fed balance sheet is still going up. And we want to keep an eye on this. This is the overnight reverse repurchase agreements. Nothing really crazy is happening here. This has to do more with the banks and overnight lending and the big banks that take part in this. We're just kind of keep an eye on this to see if anything is really acting weird. And right now it's not. Looking at the advanced decline line weekly chart, we're above the moving average based on price. We came down to the moving average based on volume, but we're bouncing back up. So this is actually turning more positive. And we're seeing an improvement here. Not only are we seeing a contraction of the new lows, we're seeing a bit of an expansion of the new highs. And so we have our 4-week going up. The 10-week moving average is trying to keep going up here. We're above zero and going up with the 19 and 39 week advanced decline ratio. This is where we're still negative with the red line way above the green line. Now, even though the red line's coming down, there's a big difference between the red line and the green line. So this is going to have to really come down and this is going to have to come up. This also suggests the trend is strengthening because we're above the moving average and we're above 20, where we're turning more positive on the daily side. We're still negative here with the Arun since this measures buyers versus sellers, and we're still below zero with the oscillator. And then the mass index, not really getting a signal here. We're getting one on the daily side, but I never use these signals all by themselves. Long term, this is a daily chart here where we were able to get back above the 50-day moving average. That's positive. If we keep going up, the 200-day moving average is still above, where we're coming back up to this. This is a previous pivot point. That's why I really like these, because this actually provided overhead resistance before, and now we're trying to come back up to about this same level. And we're seeing kind of a convergence with a lot of resistance all happening at the same point. Please watch some of the other videos that I post. I go through those things. But the market is looking overextended in the short term. We're hitting overhead resistance, not only with the S&P, but on the Dow, the small caps, believe it or not, and the NASDAQ 100. They're all kind of coming together, trying to get above, especially their 50-day moving average right now, where the S&P is above that, but those other indexes are right at their 50-day moving averages. Then we are improving here with the 50-week here moving average, and we're coming back up to the red line. Is this going to provide overhead resistance? But we look at this on a trend, we're just about ready to see a death cross here. Now, it doesn't mean we're in a bear market. It just means that we're in a downtrend. We're still in a downtrend on the daily side, and then we're possibly getting ready here to go to a downtrend here on the weekly side. Yeah, that's negative, but we could recoup from that. And we're still above the midpoint of the channel going back to 2009. That's a long-term support level that held when we were coming down, and now we're bouncing back up from it. This is actually quite encouraging, though. We were at this pivot point and we broke down below it, and we came down to this S1 pivot point. We broke down below that, but we were able to bounce up from there. Now we've been able to get back above this pivot level. It's about at 55.75, and we closed at 56.86. And this is a weekly chart, so this is quite an improvement here. If we fall, we'll be watching that 55.75 level. If we can keep going up from here, naturally that would be more positive. And we're looking positive with our accumulation distribution. This is a smart money indicator. We're above the moving average and going up. And we're trying to improve after we had been negative with the Chaikin money flow. This is smart money indicator number 2. And we're going up on the weekly chart here with the Chaikin oscillator. This is smart money indicator number 3. Now, one warning sign that I saw after Friday on the daily chart, we had an update, and the Chaikin oscillator is actually starting to turn negative. So be aware of that as well. Watch the daily video because I update all that information there. We're still negative here with the vortex with the red line above the green line. We're positive and possibly getting extreme positive with the McClellan oscillator. And we're seeing that on the daily side too, getting extreme. And we're above zero with the summation index based on price and volume. That's longer term positive. And we're seeing the same thing on the daily side. We're getting a very high reading now with the bullish percent index. We're also seeing that same reading here on the daily side. Now, we could go above this level, but this is usually when we start to top out. And we've actually stopped at this point before. So this is another concern that we've had 9 straight up days. There are people that are sitting on some gains. For them to lock in those profits, we might see some selling in the upcoming week. We are above zero and advancing based on price and volume, looking at the Swindle Trading Oscillator. PMO is showing an improvement here based on price and volume, but we're still going down overall. Momentum is still to the downside, but we're starting to look extreme with the PMOs that are rising and the buy signals. We're seeing these same signals on the daily side. We're also improving with the PMOs that are above zero. We're coming up here, but still below the midpoint here with the percent B indicator. We're actually above the midpoint on the daily side, but not seeing anything extreme. But the momentum trying to improve in the short term, but we're still clearly going down across the short, intermediate, and long term. Where the Copic curve trying to turn up here, but still negative. We're turning positive though with the force index. This is a little bit touchier indicator. And we're bouncing up after coming all the way down to an extreme negative reading with the money flow. We're above the midpoint with the Stochc RSI. That's showing an improvement there. We're also going above the midpoint with the Williams percent R, above the midpoint with the ultimate oscillator, and coming right up to the midpoint with the RSI. So you can see we're seeing some improvement, but we haven't switched back over to positive at least yet. The 1 week rate of change, we were up, but not as much as last week. So that's why this rate of change came down. But this is more encouraging. We came right down to the midpoint with the rate of change 50-week measurement here, and then we've been able to bounce up, and we're showing some improvement. We possibly, though, this is more negative. This is a long-term oscillator. The special K, we're just getting ready to drop down below the red line. And we don't get very many signals from this. So this dropping over negative could be pretty important. Now, we came all the way down to the 50% retracement level, going back to the October 2022 low to the 2025 high, and we just bounced right up off of that. We didn't spend much time there at all. We came down, bounced, and did an about face. We were able to get back above this 38.2% retracement level, and now we're starting to reclaim the 10-week moving average. So there's some positive things happening here, but we still have the 40-week moving average, which equates to a 200-week moving average. We still have that overhead. As far as our charts, we're looking better with the Heiken Ashi. That's turning positive. We're negative since we're red with the Kagi chart, but now we're pointing up instead of down. And we're still negative with the Renko chart, and we're still negative with the 3-line break. So there's still been some damage there that hasn't been repaired. And we're bouncing back up here, but still negative with the ease of movement going back 14 weeks. We did see some improvement here with the point and figure chart. We saw some new X's drawn in here with a low pull reversal. This was all the O's when we were going down, and we're seeing all the X's as we've been going back up. Still hanging on to barely being positive with the long-term momentum, improving but negative in the intermediate term, and actually turning positive in the short term. We've gone over to positive with the Elder's Impulse system for the S&P, but we're still negative with the parabolic SAR, where we continue to be positive on the daily chart. And this, I didn't update these, so I'm just going to go through these quickly. I forgot to update them. I apologize for that. I do update them every day in the daily video, but we're seeing a bit of a bounce here with the S&P. The mid caps are bouncing back up too, but they're underperforming in the small caps, which are going down an awful lot more. You can see where we're setting a series of higher lows here. The mid caps, they're just small caps anyway. They're just coming back down to previous lows. So they're just not performing all that well. The Dow is still hanging barely onto an uptrend here, but we're probably going to cross over to a downtrend. Not necessarily a bear market, but a downtrend, where the NASDAQ is now in a weekly downtrend, and the mid caps have already been in a downtrend as the NASDAQ 100 just starting to form a downtrend. And then usually I have the small caps before this. They've been in a downtrend for a while too. The NYSE holding up better, still hanging on a little bit more to an uptrend for right now. The Wilshire daily chart, we were able to get back above the 50-day moving average, but still below the 200. And all stocks, which looks at U.S. and international stocks, is improving and still hanging on to an uptrend. The FANG index really bounced back up. It was up over 4% here. We're seeing a downtrend on the daily side, and then once we saw that death cross, it's like the FANG index just did an about face and has been going the other way. ARK is just about ready to have a downtrend here, and we're in a downtrend now on the daily chart. And then if we look at May, where you just go over the last 5 years, 100% positive returns, 4 years, because I guess we shouldn't count 2025 yet, but with an average return of 1.5%. We're seeing the banks holding up fairly well. The KBW Bank Index, we're coming back up to the midpoint with the RSI. We're still negative with momentum, but it's trying to turn back up here. The Dow, this is traditional Dow theory. It's been holding up and bouncing back up. It's right back to its 50-day moving average on the daily side. The transports have really been underperforming. And as I mentioned earlier, the utilities, when we were really coming down with the S&P, utilities were going sideways. That's a defensive area. Now, you could make a case that it's a growth area because of AI and all the Bitcoin and crypto mining that needs to go on. But now, as we've been going back up, utilities have been going back up too. And looking at the broad market, We're still in an uptrend, even though pulling back with the CRB index. These are commodities. Oil is now dropping down into the high 50s, where it had been in the low 60s. Copper, this is actually encouraging. This still continues to be in an uptrend. Now it was down 4%, and it's off of its highs, but the trend is still positive, and we're still seeing a trend on the daily side too. When copper is positive, then that means the copper market anyway thinks that the economy is looking good into the future. Well, we're in a downtrend here with the dollar, but we did get back above 100. Gold is in an uptrend, but pulling back. It was going up as stocks were going down, and now it's going down as stocks are going back up. Silver is also in an uptrend, but not really breaking out the way gold has. And then looking at the total bond ETF, this is still in an uptrend. That's positive based on price. A monthly chart of the stock to bond ratio, we were starting to drop below this 10-month moving average here, but now we're coming back up at least, but this is just the beginning part of May, so we'll have to see how this plays out. This is a daily chart of yields, which had been coming down, and then in Friday's session with the strong employment report that came out, they bounced back up. Then a weekly chart here of US and UK rates, German rates, and Japanese rates. Just not really much of a change right now. And then looking at the intermarket analysis chart, where we have gold, the best performing asset in 2025, bonds in a distant second place, commodities, that's the purple line, the black line are stocks, the green line is the dollar, and then oil is the worst performing asset now. And then we look at some ratios, the NASDAQ 100, which is growth, and compare it to the S&P 500, which is growth and value, showing an improvement here, but we have been in a recent downtrend with this ratio. The S&P 100 is still in an uptrend compared to the S&P 500 and improving now. Growth to value is still in an uptrend. When we were really coming down, this ratio was coming down. Now, as we've been bouncing back up, this ratio has been going back up as well. Looking at another ratio of gold to the dollar's been going down, gold's been going up. That's why we're seeing this ratio going up. And then gold to the S&P, which now is coming back down, but had been really going up as gold was going up as the S&P was going down. And this is a longer term trend here. For a long time now, bonds have been underperforming stocks. We're starting to see a bit of a shift, but we are now pulling back. So we'll see if this can continue or if this is going to turn and go back up. Then low volatility stocks, toilet paper, toothpaste. That's what outperforms when the market's getting more defensive, but now that's pulling back. And then discretionary to staples, just barely in an uptrend here, really pulling back, but trying to bounce back up. This was a really strong part of the market back in summer and fall in 2024, but it's really changed. And then the energy to tech ratio, we were starting to see energy outperforming tech, but now that's been pulling back. Energy's been going down as tech has been going up. And then small caps and tech, not really much of a change here with the weekly ratio. Then long term, looking at the NYSE breadth thrust, not really anything that's really too blatant here. But we did have a recent ZWAG NYSE breadth thrust. This came up, and even though this is coming back down, that's okay. The signal is still there, and it goes on into the future. And looking at a long-term weekly chart going back to the 1987 crash for the S&P, we're still above this long-term trend line. This blows that up further. So we're recapturing some lost territory. And we're improving, but still negative with the 50-period moving average of the new highs and new lows for the S&P. We're still one notch down from a full-on buy signal with the Zohorchak method. It'll be more positive if that goes back up to 10. If this continues to fall, that naturally would be more negative. It's not going to go actually negative until we drop below zero. And this is a trend line going back to 2009 with the NASDAQ 100 weekly chart. We are coming back up, but we're still well below this trend line. Then we look at a ratio of the NASDAQ 100 growth versus the Dow, which is value, but even though there's some growth in there, this ratio is still holding up fairly well. We look at, again, growth, the QQQs to small caps. Excuse me, this ratio is really holding up quite well. So we're not seeing longer term deterioration to what we've seen in the past. And then looking at the new highs, new lows for the NYSE, it's rebounding here, but still below zero. And then we keep an eye on the 3-month yield. We like that this is just going sideways for right now, not like what we saw in late 2007 going into 2008. The cumulative new highs and lows for the NASDAQ continue to drop off. That's longer term negative. Seasonality, and I didn't change this. We should be looking at May right now. We're up 60% of the time. If you go back to 1964 to 2023, but over the last 4 years, a really good track record. So you can just kind of take this for what it is. And then we're coming out of the more positive time. Believe it or not, April is usually a positive time. And now we're coming to the bottom end here, May to October, where this is typically seasonally an underperforming time for the market. Then going back to 1950 and a post-election year, looking at the S&P for May, we're up 12 out of 18 times. We're down 6 out of 18 times. So that's not too bad with a return of 1.6% on average during a post-election year. Then this also, no matter how you look at this, with the post-election year looking about the best for May. Then the first half of May tends to be weaker to pretty not good. Where the second half of May, that's usually if we see any strength that comes later on in the month. These are just seasonal tendencies that we're seeing here. So thank you. I hope you have a wonderful weekend, and I will talk to you in the next video.